Welcome to Uncommon Capital Quick Takes. Short episodes, smart insights, real-world investing explained simply. In just a few minutes, we'll break down one topic shaping private markets and the economy today. Today, I want to cover three things that matter in private credit right now. There's been a lot of noise in the headlines recently, and I think it's important to separate what's actually happening from what's being implied. So let's walk through it. First, fundamentals. Despite all the negative headlines, the underlying fundamentals in private credit remain sound. Default rates were about 1.5% in 2025 and are expected to rise modestly to around 2% this year. That's not a spike, that's a normalization. At the same time, credit metrics like interest coverage are stabilizing and improving. There was a lot of concern late last year about the potential wave of defaults, but 6 months later, that has not materialized. And importantly, many of the high-profile issues that we've seen have been idiosyncratic situations, not broad-based deterioration across the asset class. What we are seeing instead is a healthier market. Deal activity has slowed, spreads have widened, and underwriting is becoming more disciplined. Leverage is coming down, equity contributions are going up. All of that points to a more balanced environment for lenders. Second, asset-based finance. This is one of the more interesting shifts happening in private credit today. Asset-based finance is a broad category, but at its core, it refers to investments backed by contractual income and hard or financial assets. That can include housing, commercial real estate, infrastructure, or consumer credit. There are a couple of reasons this area is gaining traction. One is that banks are stepping back from parts of the market, regulatory and capital constraints, which is creating more room for private investors. The other is that investors are thinking more carefully about risk. Concerns around inflation and potential disruption of intellectual property from AI are making hard asset-backed investments more appealing. There are also secular supply and demand imbalances in some areas of asset-based finance that are supportive. Housing is probably the clearest example. If you look at the data, vacancy rates are still very tight. Rental vacancy rates are in the mid-single digits, and homeowner vacancy rates are closer to 1%. That tells you supply is still constrained, which supports both pricing and rental demand. These opportunities exist both in the U.S. and internationally. More broadly, across asset-based sectors, returns are tied to underlying assets and contractual cash flows rather than purely corporate earnings. That provides diversification and, in many cases, more structural protection. Third, and maybe most important, is the trade-off between yield, alpha, and liquidity. Private credit is attractive because of the yield advantage. Today, private credit generates yields that are roughly 2 to 3 percentage points higher than public high-yield markets. That difference is the liquidity premium. You're getting paid more because your capital is less liquid. But it's not just about yield. Private credit is also an alpha-rich space. We can see this in the dispersion between the top and bottom performers, which is around 13%, much wider than the roughly 3 to 4% dispersion in public markets. That highlights a meaningful opportunity, but it cuts both ways. Outcomes are more dependent on underwriting, sourcing, and discipline. Picking the right manager matters a lot more. And this is where recent redemption headlines come in. Private credit is not designed to be a daily liquid asset class. Semi-liquid vehicles typically offer limited liquidity, often around 5% per quarter. If investors request more than that, they receive a pro rata share. That's not a flaw. That's how the structure is designed to work. So when we take a step back, the key takeaway is this. The higher yield and the alpha potential in private credit are not a free lunch. They come with a cost, and that cost is liquidity, along with the need to be selective about managers. For investors who understand those trade-offs and can take a long-term view, today's environment is actually becoming more attractive. Spreads are wider, underwriting is stronger, and the opportunity set is expanding. And that's what really matters right now. I'm Brian Resnick, and this has been an Uncommon Capital Quick Take.